morning. My name is Rachel Alembakis, and I'm the publisher of the Sustainability Report. Welcome to this discussion, Integrating ESG in Fixed Income Investing, in which we'll talk about how environmental, social, and governance factors can shape how asset owners and managers set fixed income portfolios. The benefits of ESG investing, integration in equities and other asset classes has been well established, and fixed income has been seen as the next frontier in ESG research utilization. For long-term investors like asset owners, where fixed income can represent a large proportion of the portfolio, managing downside risks and evaluating strong investments is particularly important. We'll discuss this with a panel of expert practitioners today. To start off with, Michael Salvatico, who's the Vice President at MSCI ESG Research, will start us off by exploring how ESG research and the macro ESG risks can impact on investments in a fixed income portfolio. Then Adam Kirkman, who's the head of ESG at AMP Capital Investors, will then turn to corporate bonds and the key reasons why integrating ESG into a corporate bond portfolio can make a difference and how AMP Capital approaches this subject in their investments. AMP Capital is a fund manager with more than $130 billion in assets under management, and it has more than a decade of experience integrating ESG factors into investment decision-making and active ownership practices. Then Norman Tweeboom, head of Index, Portfolio and Risk Solutions for Asia at Barclays, will present and discuss how ESG can be used to develop a fixed income benchmark. In June of this year, MSCI and Barclays launched the first fixed income benchmark indices based primarily on ESG factors. The Barclays MSCI ESG fixed income indices, and they were developed using Barclays fixed income indices and MSCI's ESG research. There are three categories to the indices: Barclays MSCI socially responsible indices, the Barclays MSCI sustainability indices, and the Barclays MSCI ESG weighted indices. They serve different ESG investment objectives. And then Bill Hartnett, who's the head of sustainability at Local Government Super, will give us the asset owner's perspective. Local Government Super is a $6 billion public superannuation fund, and more than half their funds under management are invested in responsible investment strategies. Last year, ESG moved its government bond portfolio to a strategy that incorporates explicitly ESG analysis into the selection process, and it includes a specific allocation of up to 15% into green or climate-themed bonds. So we have an expert panel here today who can discuss different factors of ESG investing in fixed income indices. So welcome. Michael?
Thanks, Rachel, and thanks everyone for coming today. I'm very excited to talk about the ESG fixed income research that MSCI is doing and the Barclays MSCI fixed income indices. I'd like to start with a joke, but today I thought of something different. There was something popped into my mind which is almost more appropriate, and it's a quote. And I want to see if anyone in the room can guess the investor for this quote. He says, "It takes 20 years to build a reputation and 5 minutes to ruin it." So we're all on the same page there. Warren Buffett. He continued on there and said, if you think about that, then you will do things differently. Very wise words from a successful investor. Working at MSCI gives me the opportunity to speak with many stakeholders in the investment community about the things that they're doing, such as discussing the research and tools that allow investors to include the ESG signal into their investment process. Signals that can improve the risk-return profile of their investments, as well as assisting with engaging the companies to improve their operations and make them more sustainable. For a long time, this has been the domain of equity investors. And over the course of this session, we'll be discussing how it applies to fixed income. But first, I want to establish the basis of this discussion and ensure that we're all on the same page when we're talking about ESG. Because there are a few acronyms in the industry. You've got SRI, CSR, CSV, and I'm sure many that you could add. I'm not going to be adding any new acronyms today, but I will be talking you through the different ways that ESG research helps improve the investment process. Today, ESG research has defined itself in the investment community as identifying the risks and opportunities that a company is exposed to that are not necessarily captured by traditional analysts. This appeals to mainstream investors who are more focused on the earnings drivers of a company and events that will impact its operations. Companies face a broader set of risks today. The traditional risk assessment tools need to be expanded to take these risks into consideration. The externalities that a company has relied upon to beef up its profits or make it more competitive are being internalised. As an investor, this impacts the attractiveness of a company, both from a valuation perspective and a sustainability perspective. The pressures to internalise these costs are coming from regulators, consumers, and the general public. Companies can no longer abuse the environment, their labour force or local communities and be sure to get away with it. With the rise of social media, the effects are wide-reaching and the impact's surprising. And we only have to look to the Arab Spring and see how mobile communications can have a massive impact. We are witnessing the pressures for health and safety improvements with what we see happening in Bangladesh. And China is faced with massive pollution problems, as well as environmental problems. These are so deep, these problems are becoming social issues. Companies face increasing pressure to be responsible for the impacts of their operations. An example closer to home is Bathurst Resources, which was valued on the potential to extract minerals from a nature reserve in New Zealand. The sell-side analysts rated the company quite strongly as a buy, but we rated this as a high risk and gave it the lowest company rating, a CCC. And why was this? It was because of a very rare carnivorous snail. That's right, a meat-eating snail. So I'm not sure whether this was such an environmental issue or whether it was just a personal safety issue for the people on the site. The share price crashed and there was much uncertainty for many months. Things have changed, but during that time, people weren't sleeping well at night if you were invested in Bathurst Resources. Another example is Qantas, whose price declined over 33% from the period where we rated Qantas to the period where we saw the industrial relations totally break down and the company stop its operations for 2 days. Now, some people might say that, well, that needed to happen and valuations were good for Qantas at that stage. But from a reputational perspective, the impacts are wide-ranging. And my personal experience with Qantas is they have some problems to deal with, especially from the increased competition. And I'm not just saying that because they downgraded my frequent flyer status. Another reason for the increased ability to analyse and compare companies on material ESG risks to operations is the increase in the availability and quality of data. The improvement has been immense over the last 5 years. Not just data from a company. When we're looking at companies, we're not just looking at the data from a company, but we're looking more broadly from sources such as governments, regulatory authorities, industry groups, and associations. This is no easy task. It involves massive amounts of resources. MSCI ESG research captures hundreds of data points from multiple providers. To make this data useful and to make the analysis meaningful involves deep understanding of the data points and an expertise to make this data comparable over time and across industries. So that this risk exposure and risk management information is useful to investors, MSCI quantifies the risk exposure and risk management. By combining a company's ability to manage their exposure to an ESG issue, you end up with an overall company rating. If you like, a measure of a company's exposure to a risk and its ability to manage that risk. It's these ratings that are being used in the fixed income indices. There are 2 more risks to which an investor is exposed, and I'm going to quickly introduce those now. The first risk identifies what a company has done, how it has behaved in regards to its treatment of the environment, to its labour force, and to local communities. Some behaviour is unacceptable, even if it does not appear to have a material impact on a company's earnings. This analysis is captured in the MSCI Impact Monitor research. It provides a measure of a company's behaviour relative to a set of global standards, as captured by the media in events. Companies such as Rio, Zijin Mining, Freeport-McMoRan, Walmart, Royal Dutch Shell get red flags. These are severe and structural issues. A red flag is the lowest rating that we have in this analysis. The second risk refers to what a company is doing today, where it is generating its revenues. And this is the origins of ESG, labelled SRI, the socially responsible investor. This is the values-oriented end of ESG investing, where investors' values determine what they will invest in, or more to the point, what they won't invest in.
Adam Kirkman, on a perspective from the corporate bond perspective.
Sure. Thank you. Good morning, everybody. My name is Adam Kirkman. I'm Head of Environment, Social and Corporate Governance at AMP Capital. I'm based in our Managing Director's office, so our corporate function. My responsibility involves working right across our business, all asset classes, looking at the frameworks and strategies for how we integrate ESG considerations right across our portfolios. So that involves working with other ESG specialists, research and others that are embedded across our business. I'll sort of give you a bit more of a flavour as to what that looks like as I get further into my introductory comments. And over the course of the discussion, I think you'll probably see how that's sort of brought to life a little bit in terms of the investment process. As Rachel mentioned earlier, we manage about $130 billion across total funds under management. In fixed income, that's a fairly large chunk of that 130. It's around about $40 billion. We've got one of the largest fixed income teams in the region, and we invest broadly across both corporate and sovereign bonds. We've also, for a number of years, been, I guess, the largest manager of what you might consider to be called dedicated SRI funds or responsible investment funds. So these are funds that we've been managing. For example, we launched a sustainable share fund something over 10 years ago, back in 2000. Our entry point, though, into this space in the fixed income context began about 4 years ago when we launched a global responsible investment leaders diversified fixed income fund. And that's a fund that invests in sovereign debt, corporate securities, in both developed and emerging markets, but it uses the investment process is structured around an ESG framework. And that framework involves the use of things like country ratings, sovereign ratings. It couples that with in-house ESG research, leveraging in particular our ESG equities research team. It does apply grey listings to certain securities if they can sort of shift in and out of the investable universe and will go onto watch lists and other things like that. They do apply some limits to exposure as well and non-investable grade stocks, and that includes credit default swaps and other things in a fixed income context. As I said, the main reason for talking about corporate bonds from our side today is that it hopefully provides people with an insight as to how we've leveraged our equities capability, and we're now bringing that to life within a corporate bonds fixed income perspective, because at the end of the day, the analysis that you need to undertake to determine things like materiality of ESG issues, whether you're looking at it from an equity perspective or a corporate bond perspective, they are in many ways much one and the same thing. You're really trying to get a deeper, more detailed understanding. So picking a security from a corporate bonds perspective is much the same as picking a stock from an equity perspective. There's very much within, if I go sort of broader and beyond that, as we start to migrate away from sort of fixed income responsible investment leaders fund, I mean, that fund was created specifically for a number of our clients that were looking for a stronger tilt or a stronger bias towards ESG issues. So there was a market demand there. We developed a product that matched the mandate. There's a real ethics committee that sort of monitors compliance with that mandate, other things like that. But as I indicated, part of my broader role is to really look at how we integrate ESG issues across that $130 billion portfolio, total portfolio. So that is essentially driven by our commitments as an early signatory to the Principles for Responsible Investment, which is a commitment to look at ESG integration in its broadest sense across the business. So I start with the example of a particular product that was developed with an ESG framework, but now I'll give you a bit more of a flavour as to what it looks like when we look at ESG from a mainstream fixed income portfolio perspective. And that is essentially driven by the commitments that we've made that are outlined and captured in our ESG philosophy that's signed off by our Managing Director and our investment committee, which I report to on a regular basis around our progress around ESG integration. And that clearly defines what the expectations are of each of our particular investment teams as to what the goals and aspirations are around doing more detailed analysis on ESG integration.
Good morning, all, and on behalf of Barclays, it's a pleasure to be here. This is a very important topic for us. We believe that the introduction of the Barclays MSCI ESG indices is a key milestone in the development of the fixed income ESG landscape, and it fits quite nicely into our continued commitment to develop the fixed income index landscape. Barclays is a leading fixed income index provider globally. We estimate about 6 trillion, and that's with a T, of assets under management against some of our flagship indices globally. Indices such as the global aggregate, the US aggregate, or emerging market high yield indices. We have by far the deepest and broadest coverage across government bonds, quasi, corporates, securitized, investment grade, high yield, floating rate, fixed rate. It's really our role to provide the investment community with objective, rules-based, transparent benchmarks to help them in their portfolio management relative to these indices. And the addition of a ESG fixed income index is just an extension of that role. We believe that giving clients the ability to objectively view the choice set that's available to them is a key responsibility. We take that extremely seriously, and we certainly welcome the partnership with MSCI, a leading provider of ESG research. We think this joint venture makes a lot of sense. Barclays is a leading provider of indices, MSCI a leading provider of ESG research. Combining those two provides the capital markets, the investment community, once again with a choice set, an opportunity to view that particular risk. It was touched upon in the introductions around equities. Fixed income is a different animal, if you will. We called animals a few times on the panel this morning, so I'll just continue that theme. But the market size is larger. There are more diverse set of issuers. Again, I touched on some of those: governments, quasi, corporate, securitized. So it's a very different asset class in some aspects than equities. And you really need expertise to be able to manage against the fixed income asset class. You need expertise to provide indices that track the fixed income asset class. And so the design, the construction of these indices is extremely important. In the introduction, Rachel mentioned the 3 categories that we are tracking. So the socially responsible indices is one category. We have the sustainability indices and the ESG weighted indices, and I'll go into some of those construction details as part of the panel discussion. It's again very important. We believe that this will be the difference. It will offer clients the opportunity to now, on an objective, rules-based fashion, observe the performance of ESG mandates, and we look forward to working with both the asset owner community, with the asset management community, with the consultant community. These are all key stakeholders in the process, and the index provider serves a key role in working with all of these stakeholders. So I'll pass it over to Bill.
My name's Bill Hartnett. I'm Head of Sustainability at Local Government Super. We're a bit of an introduction. My role is very investment focused. I report straight into the Chief Investment Officer and also to a CEO, and my investment committee is pretty interested in everything we do in this area as well. We've had a very strong commitment to responsible investment for over 13 years. We're a $7 billion fund, working and managing the retirement savings of current and local and retired members of local councils in New South Wales. Of the $7 billion, we've got $3.7 billion in defined and defined responsible investment strategies across 5 asset classes, including sovereign bonds. Our strategies have been negative screens, ESG integration. We do a lot of proxy voting. We invest a lot in thematic type investments. as well. My focus today in our conversation, thematics, sorry if I'm jumping forward, I suppose we're looking at investments in such areas as clean technology and private equity, trying to see opportunities that were coming from transitions to low carbon economies and so on and so forth, trying to develop those products and markets. My conversation today will mainly be on sovereign bonds. We have introduced a mandate called the Sustainable Global Sovereign Bond Index. But I would just like to point out in the area of fixed interest, we have actually got two absolute return strategies, credit strategies that we've been running very successfully for a couple of years, that have our exclusions that we have on tobacco, armaments, gambling, uranium, and do include some governance analysis as well. And when speaking with the managers on this, we always are getting good performance, and we're not. I'm required by the board to find out and ask them if the ESG influence is impacting negatively the performance of the portfolio, and the answer is always no. So, we don't have any problems. It doesn't inhibit their ability to manage those sorts of portfolios. But I'll go back now and concentrate more on what we do and apply it to sovereign bonds. So, local government Super has had a long-term commitment to responsible investment. It's a twofold reason. It's alignment and branding with our members who are often at the grassroots of sustainability type initiatives. And, for a super fund, we've got to have our own license to operate. We've got to be why choose us over other super funds? It is important for our members, and we get very good feedback on it as well. But, I have to say I've got a board that has always been very steadfast that if you see a risk, you should address it. And there is often, the whole industry we see as ESG as representing, investment risks. That is certainly the case that we do. And so we attempt to measure it and manage it across all asset classes. I think the important difference here that needs to be reiterated is the role of the asset owner, the superannuation fund, the ultimate owner the ultimate owner on behalf of members, and the end of the investment chain. Why it is so different for us is that we're often just the repository, I'll say the right word there.
Not suppository.
I thought I'd leave that to you, Adam, to say that. We're the repository. We are holding the investment outcomes and analysis that a lot of people down the chain, through the supply side, through the fund managers, through the directors of companies, have told us are good investments. We have to sit there, particularly for an index strategy. You're just sitting there. If you've got an index strategy, and a lot of these funds, these superannuation funds, are big. We're 7 billion. We're about 15th biggest in Australia. You're bound to have some sort of passive or quasi-passive type strategies, and you're just sitting there with a lot of stuff that is just replicating a broader market, be it equity market or a bond market. And we don't really have much say in it. But we are meant to be forward-looking. We are meant to be long-term, and it's a wonderful, and it's a big distinction, I think, between super funds and fund managers as well, in that we can be long-term in the way that we're thinking, even if we're probably not as long-term as we really should be as well. But we're also a universal owner, and for those who aren't familiar with the concept of universal owner, it's been touched on a little bit before, the area around externalities. We can't, as I said, we're sitting there holding the assets. We can't avoid negative externalities. If there's pollution going on that a company isn't paying for, another part of my portfolio will be impacted by the negative impacts of pollution. So we cannot escape that. And also it makes it, I suppose, incumbent upon us, and our policy, our SRI policy, drives us very much along the area that, which I think is difficult to refute. I suppose it's more ethics or values driven, but it can also be difficult to refute. If that cohesive societies, healthy environments, companies that demonstrate strong corporate stewardship and governance, just create better investment conditions. Okay, so that's how we stand off, and then then I can let my fund managers get some great ideas on what they want to do there. But if we, by and large, have a healthier sort of coherent and cohesive sort of conditions in which to make investments, then we're going to be better off. And that's very much not just an ethics or a values-driven point, and certainly you can see it the other way around. When there's riots and wars going on, it's not really great for investment at all. I mean, it's pretty well self-evident, I would have thought. So we see this as fundamental to fulfilling our fiduciary duties, and it really does make it pretty key with our alignment with our managers and our service providers, this distinction and how we can work on it together. So how do we go about trying to assess which asset classes we look at ESG risk and integration, and what other sort of approaches that we can do? As I said, we do it across our entire fund, and I will link it in again with sovereign bonds and what we did. We started a mandate back in March 2012, using MCI ESG research via a fund manager called Amigo, who worked closely with us with our mandate. We put all of our money that we'd allocated into government bonds into this strategy. So what's the first step? Well, the first step for us as an asset owner, again, we're looking down at asset classes, doing regular review of asset classes. And the important thing for me is to understand very much first and foremost, what is the investment objective that we have for this asset class? Do we want to be passive? What's our risk appetite? How much of a budget do we have to be, active versus a benchmark? So if you do have an appetite to be active against the benchmark, then it really opens up a lot of opportunities for ESG. If you're integration and type products, if you're being more passive, well, introduction of things like indices are starting to get more interesting as well, because in many ways you're just trying to change your sort of index, but you're trying to get some sort of beta, a market beta. So this really is this very much important first step for me, is to understand the investment objectives, understand the risk appetite, and then for me, being the ESG person in the company, is to try and gauge the ESG risks and whether ESG can be beneficial. Integration of ESG tools can be beneficial to improve the risk-adjusted returns.
Gentlemen, thanks for the introduction. And obviously this raises a number of questions that I hope we can talk through. I think one of the first questions that I'd like to address, Bill's talked about how integrating the ESG factor process into the government fixed income bond portfolio has tilted it towards governments that are less corrupt, governments that are well governed, and factors like that. But how does integrating ESG factors impact overall on portfolio construction?
You could almost say that we've chosen the simplest approach, without wanting to load ourselves up on extra work and resources, but also an effective approach. We've taken the same analysis that we use to assess the equity issuances of a company and applied that to the fixed income. Now you might say, they're two different beasts. Again, another animal reference for you. Two different beasts, but essentially what the ESG research provides is the risk exposure of a company and its operations to material drivers and its ability to manage those risks. And those are equally important to a fixed income security as they are to the equity that a company issues. The ESG research is identifying where a company is more exposed to an event. So if we have an event, whether it's a one-off event like a BP event or a carnivorous snail event in New Zealand, or whether it's a systemic event that hits a whole industry, like a natural disaster, climate change, aging populations, obesity, so on. Each company within an industry, because they're competing with an industry and they have similar operations, each company is exposed to an event. And what ESG research is doing is saying, right, let's identify those companies that are most exposed to an event and have the least ability to manage it. So when an event happens, when there is a disaster, like a BP disaster, which companies are going to have their operations most affected? And that's going to be just as relevant for a fixed income investor as it is for an equity investor. Because even if a fixed income investor is holding their the security to term, and you might say, well, it doesn't matter, a bit of a rocky road. I'm telling you again, it comes to sleeping well at night. And the ability to on-sell that security if you need. Just to put that in context, I know we talk about BP a lot and sometimes it seems to get a bit of a drag, but think about it. If BP had have had the ability to manage the disaster, potential disaster, then they could have shut down that oil leak the next day and the Gulf of Mexico disaster wouldn't have happened. That's why they were rated in the bottom quartile of our analysis, but well and truly before that event happened.
I might just pop in here about BP because, it's a good example, I suppose, of, a major event, a major shock. And, a lot of talk about bonds, it's being much more cupped on the upside, and if you hold to maturity, you only get to, 100, and that's all. We just pulled out some figures, actually, what happened to BP's share price in a 5-year bond back in 2010. So just, to food for thought, I suppose. The share price of BP in 2010, prior to the Deepwater Horizon spill, was £65. It quickly went down to £30. So about 50% drop, and 3 years on, it's at £43. There was a 5-year bond introduced or issued by BP in 2010. It was trading at £1.04 pence. It went down to 85 pence, so about a 17% drop, and now it's recovered. So it's £1.11. So I think there might be more expert fixed interest people in the room here that can tell me more than it does for me. But certainly, I think it dispels for me the idea that bonds have no volatility in them. And certainly when you're wanting a portfolio and what you're wanting from an asset owner is less volatility, that's why you look for bonds. So, looking at ESG integration from this perspective is important, even though it has been, the full value has been recovered there. Anyway, but I thought
good point.
I'd bring it in.
I might just sort of add to that, because in my intro I sort of said that I'd get a little bit deeper as to what it starts to look like when you're doing the analysis on corporate securities, and I've also got other perhaps well-known examples and less well-known examples where understanding ESG has added some value. So in my intro I said that in fixed income it's really about risk avoidance, loss given default, probability of default. But from a credit analysis perspective, what are the issues that they might become interested in from an ESG perspective? So you're really trying to sort of say what is ESG issues are out there that could affect the credit risk spread. So you might start to pick apart, well, what sort of external ESG related commitments has the company made? Michael touched on this, I think, which is important, is about you're trying to sort of identify those companies that are leaders within their sector or leaders within their industry, because ESG issues look different depending on which industry sector that you look at. You have high profile, heavy intensive industrials where health and safety and all of those types of things are a risk, whereas in telcos or banking it might look particularly different. You might ask yourself questions about, are they a fast follower in adopting good ESG practices, or are they an industry leader? On the flip side, do they actually have a history of contesting ESG related issues? And I'll touch on General Motors in a little while, because if you sort of go back to look at what happened with them a number of years ago, there's some interesting ESG touch points on that as well. What's their exposure to new legislation or product liabilities? On the upside, how are they placed on the development of new technologies, new products, new services that are all of a sudden going to take a company in one sector and all of a sudden they're going to jump up the ladder 3 or 4 pegs above other companies within their industry? Alternatively, are they close to insolvency? Are they really just running this machine on a dirty rag? Bill's right. If you had a good look at BP in the lead up to what occurred in the Gulf, there's lots of issues there that make it quite interesting, that if you were dialed into those, you would have made a very clear investment decision. I think the other thing is, I touched on materiality as well, but I think when we look at our focus versus that equities, where can you take an optimistic view on a particular company? It's really about well, what could go wrong for this particular company over the duration of that we're going to stay invested. So what we try and do is really try and adopt metric-based approaches. We take our ESG research that we do internally on the company. We then apply or position that as a score in much the way that MSCI would. We use a 1 to 6 in our equity research. We translate that to an A to F for fixed income. It works quite nicely for those guys. We then start to apply double plus, double minus, negative ratings depending on where those companies sit from an ESG research perspective in terms of things like industry risk, which is sort of akin to sustainability risk. What are the key sustainability drivers that are going to impact that sector over the next 5, the next 10, the next 15 years? What are the external factors that an industry is facing? We've touched on tobacco and other things. Ask yourself the question, is that just a sector that's going to become increasingly tightly regulated? We're already seeing some large funds in Australia that are basically just backing out of it completely. Where are there positive or negative, tailwinds or headwinds from a sustainability perspective that are going to impact a particular sector? In terms of the other things that you want to try and understand is company risk. Where is this company sitting, as I said, relative to others within its sector? Relative position on earnings, and again, it all comes back in fixed income to its ability to service debt obligations. The other interesting one, which I think we're still working on as well, is country risk. And when I say country risk in a corporate bonds perspective, I'm not referring to sovereigns, clearly. I'm talking about country risk in terms of where do these companies operate. If you're a mid-tier miner who's started life in Western Australia and now you're going to sort of embark on exploration in Sub-Saharan Africa and other things like that, you really got to start to get a feel for who's doing what where in different parts of the world, in different geographies. How much risk does that start to bring into the portfolio if you were going to go and invest in that particular issuer? The other thing that we do is, in addition to this research, it's regular meetings. Like our ESG research team has weekly meetings with our fixed income credit analysts. What are you following at the moment? This is the way our portfolio is structured at the moment. Is there anything you want to bring to our attention? Anything in here where there's major flags from an ESG perspective? And that's essentially what we're trying to do. I absolutely welcome the development of indices and things like that. Where we feel that we go a step further is by having people having constant dialogue on these issues with the people that are managing the money, with the people that are doing the credit analysis. They can get up. If they see a flag that's presented to them on a particular company that all the rest of the fundamental credit analysis looks beautiful and you're saying, well, let's just go for it. But then it's got all these ESG flags attached to it. That then triggers a conversation where people can get up and walk 20 feet and pull the ESG analyst aside and say, we've noticed this. Tell us why. Where's your conviction coming from around why you think they've got such a negative conviction on ESG related issues? So in addition to that, just to give you a feel for the type of information our teams are getting, they're also getting positive and negative watch lists. So I talked about things like grey listings and things like that. Even companies that they haven't thought about including in the portfolio yet, they're already getting information about companies that we think are on the way up from an ESG perspective, or alternatively they're on the way down. That gets included in a strengths, weaknesses and opportunities and threats kind of analysis.
Rachel, in the index space, we understand from an asset owner perspective, the asset allocation decision is already complex, right? Yeah. And for the portfolio manager and the asset management company, managing against that mandate is already difficult. So the index provider should not make that process even more difficult. Right? So we are all about transparency. We're all about making indices that are rules-based. We believe it's important that the index is replicable and that clients can understand what's included in the index, why, and how issues drop out of the index and why. Right? So the turnover process in the index is extremely important. Then you need to have access to the data. You need historical data. Right? So for the ESG family of fixed income indices, we have 5 years worth of history now. Of course, we'll continue to publish on a daily basis, so more information will become available. But it's important that the index is objective, replicable, transparent, rules-based. And in addition to that, you have to then provide clients with the tools to be able to manage against such a mandate. And portfolio analysis, risk management, performance attribution, those are the other areas where we offer services, and that allows clients then to manage the portfolio accordingly.
I was wondering, because I had pointed to this perception, that when you go out there, there's a perception that, ESG is all about limiting what you can invest in. You can't do this, I can't invest there. I'm wondering if the fact that you've chosen a series of indices, that there's the three calibrations, the SRI indices, the sustainability indices, and the ESG weighted indices, what that plays in terms of broadening the discussion from an index perspective, that ESG isn't about what you can't invest in, but rather the consideration of the full spectrum.
I
of
think
risk.
it's, that's a perfect example, because people always think about negative screening, right? And it is certainly part of that discussion, excluding alcohol, tobacco, adult entertainment, defense, nuclear, etc. But it's also about rewarding the companies that are doing a best in class within their industry or within their peer group, right? Where the sustainability indices come into play. It's about creating an overweight in terms of the ratings for those companies that are positive, that have positive momentum or a higher ESG rating, and obviously underweighting or the companies that have lower momentum. And so the choice set, and I said it in the introduction, that's the role of the index provider.
I wanted to ask, so what's guiding this momentum, do you think? Is it, and there's a couple of factors I wanted to ask about, we've talked in the introduction about the improvement of the data and the research that's available on ESG factors and ESG income. There's, you're saying, your clients, the asset owners are, asking more questions about this and putting you through your paces, asking you to do that. Is it a chicken and egg circumstance where the analysis is getting better, therefore the signal is getting louder? Or is it, is it a play from the fact that asset owners are getting more aware of this as a management issue, and therefore it's guiding the investment in research and in indices?
I think I was just going to. I'll be very quick. I think clients, local government supers, as Bill said, has been looking at this for a while, but I think generally funds are starting to, a number of years ago they're all sort of figuring out, okay, so yeah, let's do this. What does that look like for us? And they've started to sort of think about that and get comfort around that, and they know now what they want to see, and now they're getting better at saying, okay, now let's put that into practice. And I think that's starting to
I think the corporate citizenship agenda, people are more comfortable with it, and they are more willing to bring it to the forefront, saying, listen, if you cannot do these, and I'm very comfortable managing or handing out mandates against my corporate citizen agenda, then you're not getting that mandate, right? So they're voicing that much more strongly nowadays than they used to.
And then from the research perspective?
When we're looking at company risks, we're looking at external providers. We're looking at associations, governments, regulatory authorities. I mean, the list goes on, and we're very transparent about this in the methodology. It's like almost a whole page of very fine print with all the sources that we go to, and the fact that those sources are available, I think is a big difference. Adam mentioned that it depends where a company is operating. That's key to our risk exposure. If a company is operating a mine in Australia, right, it's going to have it's going to be a lot less likely that you will see a fatality there than if it's operating in India. Why can we say that? Because history shows that. You look at averages over the last 4 years, and the rate of fatalities in India is probably 10 times what it is in Australia. So we're able to capture this information, hold companies accountable for it.
I think just to add to that, though, there's a bit of an unknown in this space as well, and it's another key stakeholder which we haven't mentioned today, and that's credit rating agencies. I'll put my hand up and go on the record and say I think they are quite, they've sat back and sort of watched this. I don't think that they're really dialed into it yet. I think on the corporate governance side, yes, I would say that. But if you ask how to what extent is a credit rating agency a Standard & Poor's considering things like environmental and social risks when they're looking at company credit ratings, I don't think they're there yet. So, I mean, that in part is from where we're concerned. I mean, we have our own. We don't rely on credit ratings within our fixed income team. We have our own internal ratings, which are basically there. I mean, there's broader reasons as to why that's the case, but the whole industry's got to move together. Yeah. Good signals coming from the asset owners, managers that are working to sort of embed this as part of the investment process. Great data and indices and other things coming through, but you've got to make sure that you kind of bring everybody together, and in fixed income the rating agencies occupy a very important and key piece of that value chain. So
similar with asset consultants as well.
Exactly right. So you could almost say the same thing applies
for the asset owner, because that's the next part of the chain. But you've got to look at.
So imagine Rachel as the asset consultant in between Bill and myself. Bill and I.
I don't know whether this is a good comparison or a bad comparison.
But Bill and I might be pretty clear on what we're both looking for from an ESG perspective. I communicate that to Rachel, but then I'm not sure how Rachel's providing my feedback back to Bill or any other asset.
Yep.
And then how Bill then distinguishes between good and bad from a manager perspective.
I mean, in terms of growth, I mean, the growth has been good, but it's still pretty patchy.
Yeah.
And it's here and there, and there's interest. But there hasn't been much capability, and capability is starting to build up. But I'll go back to what I was saying at the beginning. It's alignment and it's risk. And, for all of the great work that we've been doing in this area, ESG risks are getting more severe and they're getting more frequent. So the world's not getting more sustainable as we go on our great journey as being owners of capital and deciding where the money goes and at how much. And the alignment issue is just going to get stronger. Transparency, demands on transparency. We can't keep on going and asking companies about what they're doing without members, our end clients, asking us what we're doing. So there will be much more pressure on this, and I think there'll be much more pressure on exclusions, and they'll come to much more prominence as well, because some people will just say it's just not acceptable, and it will come down to reputation risk, getting on your corporate citizenship too.
I wanted to go to, just to pick up again on what you were saying, Adam, the techniques for integrating in ESG into a portfolio. There's the overweight tilts to the indices, there's the grey list to the sin bin. But this issue of engagement, is it possible to engage as a debt holder in the way that you would necessarily as an equity holder?
I'm glad you've raised it, because there are differences.
Yeah.
We haven't sort of touched on the issue of where the interests of a bondholder differ from an equity holder. So and this becomes probably most pronounced when companies find themselves under financial stress. Who's going to be calling the shots at that point in time? Is it the equity holders or the bondholders? Because the bondholders just want their money back. Equity holders, on the other hand, may be prepared to run a high risk strategy to try and turn the company around, over the longer term. So there's points where there is very much common ground from both equity and bondholders, but there's also a point where they can diverge. So when you're engaging, which you might say, as Bill said, how do you engage when you don't hold voting stock or whatever? We find, particularly where we've got common securities in both our fixed income portfolios and our equity portfolios, it's reporting season at the moment. So we've got a steady stream. I tried to get a meeting room yesterday, it's impossible. Every meeting room is booked out because you've just got a steady stream of companies coming in. And I can almost guarantee that in every single one of those meetings we'll have our equity analysts, our ESG analysts, and we'll also have our credit analysts from our fixed income team. Because they're all interested in where the company's at, what the company's doing, that kind of thing. So that ability to engage as a bondholder is there, and it's also there at the time of issuance. I talked before about complexities around in fixed income. It might be a subsidiary of the parent company or something that's doing the issuance. So you're not always going to get that story from the AGM or the roadshow or whatever. So you need to sort of engage, and get comfort around, that particular entity within the corporate structure. And at the time of issuance is the key time to actually do that.
And you also mentioned the fact that, you know, sometimes when you invest in the company, you're looking at the whole of company as an equity holder. When you're looking at a bond, you can be looking at a subsidiary or a specific project or a specific country. How does that impact in terms of the way you engage with the company at the time of issuance? Is it easier? Does the research support that kind of project level specificity?
Yeah, well, I mean, I go back to the case in point where we did that analysis on the debt instruments in the power sector. You know, that involved, you know, credit analysts and portfolio managers from our fixed income team going and visiting the site.
Yeah.
You know, spending a day or two down there, getting a steady stream of management teams coming through. What about this? What about that? You know, so it's everybody's going to take a slightly different approach. Our approach is to try and find as much information as you can.
And then how does this play out in a sovereign bond portfolio, Bill? How have you approached it with your external manager?
Well, engagement. I mean, engagement can sometimes be interesting from asset owner, asset manager perspective as well, because I think an asset owner is always trying to press for best standards, because sometimes, as I said, you're stuck there. Whereas an asset manager can sometimes engage and say, I don't like, and I'll change the valuations and move. But in terms of sovereigns, it is more difficult. But what a lot of us we do and is around advocacy on policy. So one of the groups that many investors, AMP, I'm sure is of course you are, involved is, say, for the investor group on climate change has had very strong policy on, we want to have a carbon prices being a central part and cornerstone in the ability to manage the risks emanating from climate change. So it's more advocacy type work that we do there.
I'd like to invite questions from the audience at this time. Yes, you.
So on your social responsible indices, you've got a screening for things like military weapons, things like cluster bomb manufacturers. Do you apply that? Is that just applied on corporates or to the sovereigns that buy them?
So the SRIs are for corporate, the corporate component of the index only.
Okay, so not for the governments that buy them.
Yeah, there's very specific ways that we look at the screening of involvement in those activities. Landmines, cluster munitions, depleted uranium, and chemical weapons are the four main areas we look at in terms of ex-controversial weapons. And when we're looking at those, so for instance, cluster munitions, we're looking for producers, being those that bring a product together, as well as component manufacturers. And so, it's quite a long list.
So what about they're only being made because there's a buyer out there?
It's an interesting way to look at it. You could expand that then further. So for some of the other areas like tobacco, we do look further. We look at producers, distributors, retailers, licensors, and suppliers. So we do extend that analysis further in other areas. In terms of defence and weapons, where would you stop? You wouldn't sell anything to anyone.
I just find it strange.
I'll throw an answer there from an asset owner's perspective. The index that we use for government bonds doesn't include some of the rogue states out there that, everybody has a defence budget and things like that, but you might get a bit more comfortable with Australia than, say, Iran's or something like that. And I suppose it depends on what the index is, but I think you'll find very few asset owners who would be really keen on having bonds from Iran or North Korea or things like that. And if they do, they're probably trying to get it out because there's going to be disclosure requirements coming on all of their holdings over the next year. I find in many of my conversations with managers, just on this whole thing on exclusions and integrations, and outside of the equities area, I get more interested in infrastructure and real assets. And I say, by the way, dear, you're likely to invest in any companies that are going to make nuclear weapons or things like that. And they say, well, we don't have a formal policy on it, but really the asset owners overseas, the big ones, they really don't want to be involved in it. And so it's tacitly done. So in that space there, I suppose they've just got to get used to the idea. We'll try and get a good investment that doesn't have these sorts of business activities in that asset class, and it might start coming through into more equities and bonds as well.
That's a good point, actually. The sovereign research we do does have indicators for countries who've signed the Convention Against Cluster Munitions, for instance. So you do have the research there to make these decisions if, as an investor or an asset owner, you wish to. The same on the fixed income indices side. While there are standard indices that have been constructed, the potential is there to have these indices customised.
Absolutely.
Thank you very much for the audience, for those of you in the audience today. I think we've had a vigorous discussion going into a lot of the points of ESG and fixed income. I'd like to thank our panelists, Michael Salvatico, Bill Hartnett, Adam Kirkman, Norman Twayboom. Thank you very much.